First of all, we've seen this slide else before. The question, the economists, maybe with wishful thinking, would like to see the end of the oil age. They predicted it back in 2003. But as you were well aware, 2/3 of our energy today comes from petroleum and natural gas. And the books that we've seen written by very well-versed people in the industry have not all just developed because of some sunspots or so. I would suggest that if you have not had a chance to dig into the literature, that you do so. And one which has not been mentioned is Peter Terzakian's 1,000 barrels a second. That's I consider that one of the top reads. So anyway, we'd say it's not the end of the oil age in our lifetimes, but there would be the end of the growth in the oil age and an adaptation to a whole different world. So the objectives I have is to talk about energy sector fundamentals, my experience with King Hubbert and the Herold experience, what we've seen in Herold with data and analysis recently, talk a little bit about alternate energy, and to keep you entertained with some fishing pictures. Because I found it's kind of sobering to be in the audience here. You know, you might get a little depressed, but whenever I get that way, I think, you know, I can always go fishing. So, buckle your seatbelts. It's going to be a lot more like a movie than a slideshow. So anyway, the big issue is, what does the energy future hold? And we are at the tip of the iceberg, and our knowledge base is small but growing. When we look at Colin Campbell's famous work on alerting us to oil crisis in the future, looks like we're there. If you update things to today's production, we're at 85 million barrels a day. I note that the only time oil demand really went down was back here in 1980, and then it's turned around in 1986 when prices collapsed, and we've been on a steady trajectory northward. I got to know King Hubbert. Tom Petrie, who I worked with years ago, introduced me to King, and I worked with him, and one of my partners, Brian Widsky, and I updated the lower 48 model back in '89. We're doing another version. I'm sure there's no one can do too many efforts to try and see the accuracy of this, but we were duly impressed with King's work. I'm going to try and find a way to get a presentation that King made at a presentation we gave at Oppenheimer back in 1984, where he actually goes through his thinking about the depletion curve and what goes on. But I will share with you at the end of his talk, he pulls up a cartoon, and the cartoon is of a Buffalo Scout and an Indian next to him, and the Buffalo Scout's looking out on the horizon, and he says something to the effect, "Buffalo shortage? What buffalo shortage? Just give me more money for guns and scouts, and I'll get you all the buffalo you need." Well, we went through the whales pretty quickly, didn't we? And we went through the bison, and I'd argue that King's work is remarkable in its and how well it's predicted what we've seen. Again, another version of something you probably are aware. This is the largest oil fields discovered in the U.S. Prudhoe Bay at 13 billion barrels, East Texas. And as you'll note, the green, which is remaining reserves, is just a smidgen of the original discoveries, with the exception of Thunder Horse in the Gulf of Mexico, which is, as you're probably aware, been delayed in its production because of problems. And we look at what happened last year in terms of how significant these top fields were. Well, even though they're largely depleted, they are still some of the largest fields that are producing. The green is oil, the red is gas, and looking across the full universe. So we're living on borrowed time when it comes to the existing population of large oil and gas fields, very similar to what Matt Simmons has seen. So anyway, we asked the question is, how did we get here? We had, in my experience as an oil analyst, a 2-year boom in the market that if you weren't there was unbelievable. Prices went from $12 a barrel to the equivalent of $100 a barrel. And that boom sparked a major decline in demand, but at the same time, the North Sea and Alaska came on, and we had this major break. In recent years, I guess I've likened it to a 2-year drunk and a 20-year hangover. It seemed that way. And if you lived in Houston, Texas in the early 80s, buildings were emptied out. Bankruptcies were prevalent. People were moving out of town as fast as they could. Well, some of the assumptions that are no longer valid that have come up recently, which is now only 5 years ago or so, the EIA, CERA, National Petroleum Council, were talking about 30 TCF of gas demand in 2010. And gas was not only plentiful, easy to find, and will remain cheap forever. Well, after that proved to not be true, and then we turned around and said, well, natural gas worldwide is plentiful, easy to find, and remain cheap forever. Also not true. As we talked about, there was a huge overinvestment in combined cycle natural gas-fired generating plants, and I will agree there are no easy fixes. You may not be happy with this comment, but AE, when we look at it, could also mean awful economics in many ways, and I'll talk about that a little later. So how do we go through such a whipsaw? Here it is again, The Economist, pointing out to us in 1999 that we were drowning in oil. The price of oil at that time was $10 a barrel. The Economist went on record at $5 a barrel. To their credit, they came back later and says, we was wrong. Of course, National Geographic, I think, did an excellent job of describing it as we're at the end of cheap oil. And our big question today is, what's cheap? $60, $120 a barrel, $300 a barrel? So meanwhile, people who we deal with in our business, investors, are subject to periodic manic and depressive activity. And as you'll see, this tracks how oil prices behaved. And we went into, in '86, when we had the big decline, depression broke out. We had a bit of a recovery when we had the Iraq invasion of Kuwait, but not really because people knew that was short-lived. Another depression, another mania, anyway, we get right back up to, we've had a long run in the last 5 years of higher oil prices every year. However, just in the last couple of months, we had a decline in oil prices, and I've seen depression break out again. I've seen actually investors say, I never want to own energy stocks. I'll trade them, but I'll never own them. Now, you may be aware of this. Now, I will say that we, in the interest of good taste, left off the 2000 version. So to review today's situation, unrelenting demand growth, oil and natural gas, reservoir depletion is clearly taking place, and we're, I think, the term running up the down escalator, and the escalator seems to be going a little faster. The economists have told us that price is going to fix everything, but as Matt pointed out in his talk, $300 a barrel oil is already in the European markets, and it has had no visible impact on demand moderation. We're again suffering from this 25 years of underinvestment in upstream. The oil field service and supply business is in high gear. At last, oil companies have figured out that people are important, and they're aggressively bidding for the young petroleum engineers coming out of the schools. However, there's only maybe 1 out of 3 that are available that would be, so the young miners are in strong demand. I've heard petroleum engineering grads from Colorado School of Mines are getting $90,000 a year offers with signing bonuses. And like any boom, or we call this the 2000 black gold rush, when everybody rushes in, we have capacity constraints, delays, shortages, and nothing seems to go right, and all the projections on supply fall short. To review ExxonMobil's position, it's more of the same. You know, here's where we've been, and here's the future. Continuing growth of 1.6%, and more or less oil and gas retaining their existing market share. If you look at the oil supply, I find this a useful review of the consumers, the importers of oil. Here's the U.S., or the North America, producing about 13 million barrels and importing about the same amount. Europe, 10 million barrels a day of imports, 10 million plus of imports in Asia. quite frankly, this is interesting that South America is such a small player in the overall game. Africa, of course, is exporting about 7 million and one of the bright spots on the horizon, and Russia as well. But of course, here are the big guys, 19 to 20 million barrels of exports per day, and against a relatively small consumption base. Well, by Exxon's own admission, we began to see forecasts of a peaking out in non-OPEC supplies out here in the year 2020, 2030. And here we are today. It basically says that if this plays out, then in 2020 we need 37 million barrels a day from OPEC and 47 million barrels a day by 2030. And over here is what the history has been. Look at the volatility in the production of all the countries in the OPEC group. So I would beg the question, not only can OPEC produce 47 million barrels a day, but does OPEC wish to produce 47 million barrels a day? What is their motivation to be the supplier of last resort to a world that demands more oil than they necessarily wish to provide? Now, these are my kids. This is Allison, and that's Roy. I just like to break that up, you know, it kind of makes me feel good in the middle of the presentation. That's down in Cancun, by the way. So what about natural gas? Okay, let's trace the history as well. If you're an economist, you remember that natural gas basically was what they found unexpectedly when they were looking for oil. So during the period from the 40s to the 70s, Say's law reigned. That was, we had a lot of supply, so we created a business. We created a market for it. We built huge pipelines up and down from the Gulf Coast up to the New England states and into the Midwest, and we gave the stuff away. In fact, at the peak in natural gas consumption, the first peak anyway, back in 1970, does anyone know what the price at the wellhead was that year? 7 cents. You were pretty close, 75 cents, but no, it was actually 7 cents. So we gave the stuff away. We created a huge market. We then went into a bit of the first decline and then the second peak. And of course, the red is imports from Canada. As we learned earlier from Mr. Hughes, we benefited from this enormous ramp up in exports to the U.S. of Canadian gas, which all of a sudden, to our surprise, came to a screeching halt back in 2001. And as you see, are not going up at all, but rather going down. LNG is not the salvation that we would like it to be. And this is last 2 years, obviously, LNG supplies have heated up, but it's still less than 4% of total supply. And remarkably, in 2005, LNG deliveries to the U.S. declined. Well, how could that be? We had a tight market. We had $15 an MCF gas. Well, we were competing in a world market for this wonderful fuel, and Spain and Japan were willing to pay a premium to what our market was willing to do. At the same time, I can recall that many investors were just, heady about LNG and how LNG was going to save all our problems. Well, when we looked around, we began to find out that while there's incredible demand for LNG around the world, supplies are not there as readily as we thought. And tankers are not being built as quickly as we thought. And regas facilities, because of NIMBY and other issues, are also lagging. So LNG will be an important part of the future, but not the panacea. So we've had a remarkable run for natural gas. A couple years ago, you could buy it at the wellhead for $3. Then it was $5, $6, $7, $8.50 early this year. Pretty remarkable. Oh, now we're going to get into kind of what the facts are on what John S. Herold does. We create an annual review. We call it the Global Upstream Performance Review, or affectionately named by the Vice President of Acronyms, GUPR. The GUPR. The GUPR looks at all the public oil companies in the world, of which we have about 205. They had reserves of 260 billion barrels, And as you can read, we're significant players in the world oil scene. What we've seen of late, this is a historical, not particularly great chart, but shows that finding cost in years past on an inflation-adjusted basis were $5 until the run-up in the 70s got them up to $25. Well, we're seeing a repeat of that same cycle, it appears, today. And that's not just in the U.S., but same sort of data for overseas finding and development cost. So this 205 companies, this is what they've been doing with their upstream investment. They, over this period of time, invested about $1 trillion. Development capital was the biggest source, the blue bar, and exploration was just went up 50%. But here's the one you've been waiting for. All that increased investment did not add to new proved reserves. In fact, the reserve additions have been stuck in neutral. And here's another one that brings up the overall macro side, which says the law of diminishing supply is alive and well. As the industry has increased the number of wells drilled, the reserves added per well have steadily declined to a point now where it's just about 300,000 barrels per well. And again, another version of finding cost, we hit over $12 a barrel. Here's the 3-year average. And one of the issues we largely talk about with our clients in the oil industry is the term often used in this area, I'll back up, is capital spending. What's your capital spending going to be next year? How much you going to spend? Well, I largely counsel my clients and I said, look, it's capital investment. Investment is different than spending. Here's the difference. When my wife goes to the grocery store and buys food, that's spending. When I go to the jewelry store and buy something for her, that's investment. You think very differently about investment than you do about spending. And in fact, investment is the issue. You expect a return from those monies. I'm not going to go there. Okay, so talking about finding costs is kind of an odd thing because most people don't, if you don't understand it, having high finding cost is not good. It's like having high golf scores. That's not good. So I went in and did a little research here on how the pros have played in the last 5 professional golf outings. And for those 5 deals, one man averaged produced a 23 to 20 under par. 2 people were 19 to 15. And you can see the average was just about 4 under par. That's normal distribution, isn't it? I don't know what Happy Gilmore would have done, but he probably would have cheated. Anyway, on the finding cost side, we look at the 3-year performance of this 205 companies, and you know what? These companies apparently are finding oil and gas or adding it to reserves at under $5, under 10 to 12 or so. But remarkably, we find that 1/3 of the entire group of companies found or added reserves at a uneconomic $25 per barrel. So they're not, that's one of the reasons the industry is not gung-ho about racing out and drilling wells willy-nilly, because many companies are being reined in by their shareholders who say, $25 a barrel, stop that. We don't want to see that anymore. And there's a profound cynicism about how they invest their money going forward. In fact, many of them are now being challenged to stop exploration and development for the most part and convert to a royalty trust or master limited partnership format, as has been the trend in Canada. So the industry did replace 110% of its production, but only by benefit of revisions and improved recovery. You can see the actual finding and development cost reserve replacement has been about 80%. Oil has been the problem. We've been doing a lot better in adding gas reserves than oil, but we're only running in the order of 75% reserve replacement in oil. This is worldwide for all the companies in all the regions. And the reason gas looks good is because of some of the resource development plays, such as the shale plays in the U.S., and the addition of supplies from the LNG developments for the major oil companies. And as we said before, production didn't increase, and reserves did not increase with this increased investment either. And as we work the fields harder, our reserve production life for the oil fields has been coming down. The reason gas has been going up is, again, because of the LNG developments. And our oil reserve production ratios are down across almost every region. Again, all these slides will be made available to you, so I'm not going to linger on the specifics. And again, we had for an increase in spending of some 25 to 27%, we got a meager 4% increase in production. And if you know something about statistics, that is a little bit deceiving too, because that factors in something called a survivor bias. The companies that are existing today have incorporated the reserves of all the companies who had those super high finding costs. So it tends to make the look back better than the actual performance of the industry. So anyway, to sum up, investment increased significantly, but did not translate into reserve additions for all the reasons we know of mature basins, cost structure, lead times. We barely replaced reserves with this increased activity, and without revisions and improved recovery, it's a net positive revisions. We've had some negative revisions that aren't reflected here because Royal Dutch Shell restated its activities. Even though it lost 4 billion barrels, we just forgot about it and we restated everything. I always say that investors, it's not that investors don't like revisions. They don't like downward revisions. And we've been benefiting from upward revisions. So again, as you see, is it hard oil or easy gas? So, as you may know, we've been doing this study for some time about what we really pay for a variety of common items in a household basket. Crude oil, again, at 70. Coca-Cola is $119 a barrel. This was at $3 gasoline. Milk, Tropicana orange juice. Well, those are kind of interesting, but these are even better. Perrier goes for $400 a barrel. Would you believe you paid $1,000 a barrel for that Starbucks? That's 5 times what you pay for, or 10 times almost what you pay for gasoline. Jack Daniels is well worth it in my book at $3,273. If you're from the South, you got to have your Tabasco sauce. And finally, Visine, which weighs in at $39,728.64. But that too is well worth it after you've had that Jack Daniels. So again, in a relative scale, that's how it sorts out. So when we think about world oil production, we think about regions and plays and where those things go. But what about companies? The real thing that drives this industry, in the most part, are IOCs, international oil companies, and national oil companies. And they use this as a platform to deploy capital, technology, talent, processes. And motivated international oil companies are underappreciated and are critical to supply. These are the big guys. These are the small guys. What have they been doing? They've been acquiring each other left and right. This is what happened last year. That's oil prices in green, gas prices in red. As the worse the fundamentals of the market would be, the more likely the industry is to consolidate. So with the oil and gas prices trending south here recently, we've seen a new wave of mergers. Shell Canada will be acquired by Royal Dutch Shell in a minority squeeze out, and we'd expect to see more activity of that sort. So back in the old days, we had 45 oil companies back in 1950, and this is what they've been doing over this period of time. And in fact, Unocal, Kerr-McGee just left us in the last 18 months, and we're down to 9 big players. And some of those are kind of in the sights of the big companies too, Marathon, Hess, Murphy Oil, and others. I mentioned this trend about companies converting from being exploration production companies to trust and paying out their excess, I don't know if it's really excess, but their cash flow. And in Canada, it's been remarkable. We had, 15, 20 big companies, and they're now, most of them were acquired by U.S. companies, and they've now consolidated to just 5. So looking at what the activity of the top 10 companies, got to remember that the big boys account for 60% of the oil reserves, and you really get to the domination by the top 40 or so. So the companies in that global upstream performance review were headed by Exxon. Lukoil, PetroChina came right in after them, Pemex, Rosneft, Petrobras, Eni. So we had 7 majors, 4 NOCs, and Lukoil, which is somewhere in between. And if you want to put it in perspective, Saudi Aramco is up here, and go through the list. Here's little old ExxonMobil, who earned $10.5 billion today, by the way. Of the top 12, only 2 replaced reserves with the drill bit, Petrobras and PetroChina. If they are going to increase reserves, they would need to increase their reserve replacement rates. And this is just a diagram of, in order to achieve a 10% production growth at today's RP ratio, you'd have to replace about 150% of reserves. And as we showed, we're barely exceeding 110, 120%. Gas is doing better than oil, another version of this, across the board with every one of the large companies. The large companies are having a hard time growing. Exxon's production was down last year. Royal Dutch Shell was down. Chevron's oil, and Petrobras as well. So what's going on here? One of the issues is that for the major projects we track around the world, 2 things are slowing down the bringing on new supply. In black, political change. In blue, technology delays. And you can look around the world at all these giant projects, and they all seem to have something that's delaying them. We hardly go a day without an announcement that we have a problem. And a delay is going to take place. So to sum up, the majors' investment patterns, sporadic acquisition activity, increased development spending. They're having a hard time deploying their incremental cash flow. And what have they been doing? Well, the money came in faster than they really knew what to do with it, so they had only a couple of options. Pay down debt. This is the debt to total cap ratio for the leading oil companies, and that's the average for the group. And as you can see, we've gotten to the point now where, on balance, the majors have no debt whatsoever. That flies in the face of financial theory on maximizing return on investment. So what they've really been doing is spending money on share repurchases. In fact, last year we noted that share repurchases exceeded dividends to shareholders, and the 2 were $120 billion. It's basically, I call it a relief valve. If you don't know what to do, you can't be accused and be thrown out of the boardroom by saying buy in stock. But anyway, let's get to another subject here. Oxymorons. Are you familiar with the term? Words that go together, but they don't really make sense, like jumbo shrimp, wiggly drunk, working vacation. We talked about the Great Depression, and I said, what was so great about the Great Depression, if you were there? Well, anyway, I put this one up for consideration. Where the oil industry's been accused of obscene profits. And I don't have to defend the industry. I'd said profits are good and more profits are better. The issue is not profits, it's what they do with the profits and the cash flow. The returns have improved, and now those damn investors have changed their mind. They now prefer growth to cash. This is just an observation that's coming out of many of these. I think the fascination with share repurchases will be fast coming to an end. They are investing tremendous money in the oil sands and in LNG. And you've seen this chart before. This is the IHS generated, but EOG Resources puts it out, showing the vintage of gas and the degree to which we're approaching a 32% or an estimated 32% decline rate on current wells that are being drilled. They are investing, but it's mainly in the independents and not in the majors, though there's some indication that the big companies are coming back as ConocoPhillips bought Burlington Resources and Shell's come back to become active again. And again, on the exploration, we'd say, well, what do we need? More exploration. But as a percentage of the total capital budget, exploration has been declining substantially from 25% back here in '98 to about 15% today of total outlays. And part of that is, again, investors. Investors say, you know, we don't want you to go exploring. The reason we don't want you to explore is that you're not finding very much, and your finding costs are $25 a barrel. So as an industry, most have fallen into that way of thinking. You're aware, it'd be nice to put the pedal down and get a lot more supply, but we're flat out on rig capacity. And investors have started to note that the major oil companies, as I talked about, the share repurchase deal is not quite what it used to be. The median company, the smaller companies, are outperforming the majors substantially of late. I believe an indication that it's time for a new strategy. And we're seeing the NOCs, the national oil companies, become increasingly active in the M&A game. And this is actually a transaction that would have taken place, CNOC for Unocal, but was stopped by the political movement. But anyway, this is an indication of the depth of capital that's available to the national oil companies. So let me finish up with just a couple items. One is the Jack 2 well. When good news is bad news. Well, first of all, this discovery is about 200 miles offshore in 7,000 feet of water, and yet it was widely heralded as this was it. I took a call from a journalist the day it took place, and I said, listen, this is great news, but it's not going to solve our energy problem. And then I'm going to say, do you understand what 7,000 feet of water is? Do you realize that it would take, wells cost $100 million each, and we need special equipment to do so? And he said, yes, yes. And he said, what's it going to do to gasoline prices? And I was dead wrong. I said it's not going to have any effect on gasoline prices, and then they proceeded to fall by a third in just a couple of weeks. So clearly, he was on the right track. The psychology changed. Here's what's happened to again, back on the manic depressive. Here's the long-term price. Here's what happened to it recently, and we had a huge sell-off in the energy sector. I said an energy bear market emerged. I think that has to be a real picture. Those guys look scared. And we've seen the rather dramatic fall off in oil prices. This is what it looks like when you look at the forwards market. For a while we were in backwardation, then we went into contango. But anyway, is that going to mend or continue to decay? So this is following up. Forecast will expect that motivated capital will be out there, and that however, we have these continuing disrupting forces, and we've recently hit a downward air pocket. The international oil companies operating in free markets are critical. They are being increasingly restricted in the countries in which they can operate, in which they can operate effectively and economically. The independent companies are now thinking more about going into master limited partnerships and royalty trust, because that's a sure thing, and that gets you a higher valuation than you do as an ongoing company. And of course, mitigating peak oil may be more difficult than envisioned. So here's the fish pictures. It's my son, Dustin. So when we talk about final issue is alternate energy, this was from the New York Times. I think everybody's there is, let's grab another hose and take care of the problem. I don't know which one it is, but one of them will fix it. Well, we did a scenario planning exercise at Herold, and we came up with 4 different scenarios ranging from a kind of forward-looking market with a good geopolitical situation to a nationalistic and reactionary, an abundant access to a restrictive, and the 4 scenarios were second wind, mother of invention, wild ride, and slow lane. Anyway, you can see it affects oil prices are high. This is an enlightened society. Technology works. This would be a wonderful world. We're not there. We settled on the fact that we're probably more in a wild ride market. Well, final one, a few thoughts about ethanol. Historical ethanol production has been largely concentrated in Appalachia. Did you know that Uncle Jesse was both an environmentalist and a conservationist? And he's now subsidized by the US government. So here's how the system works. Enhanced performance. This is actually my friend Greg Armstrong at Plains All American put this together, but I liked it. And then, here we go, then, now. So anyway, on the internet you can buy this still for $6,000. Well, these guys got by a little bit less. Thanks very much.